So here's a question for you. Have you ever really thought about what your company's payroll processor and, say, your local garbage collector actually have in common? I know. It sounds like the beginning of a really weird joke. But the answer? Well, the answer opens up a corner of the market that is just packed with giants, absolute giants, hiding in plain sight. These are the companies that make the entire business world go round, and for smart investors, they can be truly incredible opportunities. I mean, just think about it for a second. On the surface, they couldn't be more different, right? One of them is crunching numbers for paychecks, another one is hauling away trash, and the third one is cooking up creative advertising campaigns. But believe it or not, they all belong to one single, massive, and surprisingly powerful sector. And today, we're going to pull back that curtain. Welcome to another video on Investment Basics by Mr. Majid Butt. Today, we're really diving deep into a topic that honestly gets overlooked all the time, but it's absolutely fundamental to how our modern economy actually works. That's right, we are pulling back the curtain on the world of business services. And what's so fascinating is that while a lot of these companies operate pretty quietly, in the background, they often run these wonderful wide moat businesses. Exactly the kind of durable, long-term investments that so many people are looking for. So here's how we're going to break it all down today. First, we'll get to know these invisible giants. Then, and this is the really important part, we'll introduce a powerful framework for analyzing them by exploring three core business models: tech-based, people-based, and hard asset-based. Oh, and you'll definitely want to stick around to the end because we're going to wrap it all up with a super practical investor checklist that you can start using right away. All right, so the very first thing we need to get our heads around is just how incredibly diverse this sector is. The term business services is this huge umbrella, and it covers a mind-boggling range of companies, and each one has a fundamentally different way of creating value and, of course, making money. I mean, just look at the variety right here. You've got a data processor like Fiserv, which is a super technical business-to-business software and service provider, and then you have waste management, which is really a capital-intensive logistics and real estate business. Then you've got an ad agency like Omnicom. That's all about creativity and relationships. And you even have an airline like United, which is a consumer-facing transportation company. When one sector has companies that are this different, a one-size-fits-all analysis just isn't going to cut it. No way. And that's exactly why we need a better framework. So what's the common thread here? What is the one massive economic trend that's powering all of these businesses that seems so different from each other? Well, it turns out they're all riding the very same powerful wave. And that wave is outsourcing. It's a simple idea, but it has been absolutely revolutionary. It's the idea that businesses can save a ton of time and money by hiring other, more specialized companies to handle tasks that aren't central to their own mission. This lets management focus on what they do best, whether that's making cars or designing software or running a restaurant. And in the process, it has created this massive market for all these specialized service providers. And this isn't just some abstract theory. You can see the impact right here in the numbers. Look at this chart. In just about a decade, from 1990 to 2001, business-to-business services exploded from 3.5% of U.S. GDP all the way up to over 5%. Now, that's not just some small niche growing. That is a fundamental tectonic shift in how our entire economy is structured. Okay, so to really analyze these diverse companies in a smart way, we're going to use a simple three-part framework. We can basically categorize any business service company based on its primary value driver. So the question is it leveraging technology, people, or hard assets? Figuring out which bucket a company falls into, well, that's the critical first step to understanding its true potential. Let's start with that first model, tech-based businesses. These are the companies whose entire competitive advantage is built on code and networks. They're leveraging proprietary technology and software to deliver their services at a massive, massive scale. Think about companies like data processors, like Fiserv, or maybe database providers. The business model here is just so powerful. A company like Pfizer, for instance, makes a huge upfront investment to build something complex, let's say a check imaging system. That incredibly high initial cost creates a massive barrier to entry. It's just too expensive for new competitors to even try. But, and this is the key, once that system is built, the ongoing costs are incredibly low. They can then take that initial development cost and spread it across hundreds, maybe thousands of banks, which makes the service super cheap for each individual client. And to top it all off, they lock in these customers with long 5 to 10-year contracts. And that creates very predictable, very stable, recurring revenue. So, what does a best-in-class tech-based company really look like? Well, for starters, they are cash-generating machines. They just throw off cash thanks to massive economies of scale and something called operating leverage. All that really means is once their fixed costs are covered, every new customer they add is almost pure profit. It's incredible. Their long-term contracts make their financial performance stable and predictable, and ideally, what you really want to find is a company that's still operating in an under-penetrated market because that signals a long, long runway for future growth. All right, next up, let's look at the second model, people-based businesses. And this is a totally different ballgame. Here, the primary asset isn't code or a fancy network, it's the employees themselves. We're talking about consultants, ad agencies, staffing firms. You get the idea. This quote just nails it. It perfectly captures the business model. A consulting firm might pay an analyst, say $50 an hour, but they'll bill that person out to a client for $250 an hour. The company's profit is that spread on their employees' time. And what this means is that growth is directly tied to their ability to find, hire, and keep more skilled people. Unlike a tech company that can scale almost infinitely with software, a people-based firm scales one person at a time. So success in this space looks a little different. Because the service itself can sometimes be hard to differentiate, a strong brand and deep, deep client relationships are everything. You want to look for companies like Robert Half, which did a brilliant job differentiating itself by focusing on professional labor for smaller employers. And you really want to see healthy organic growth. That means they're winning new business on their own merits, not just by buying up other companies. That's a true sign of a healthy business. And that brings us to our third and final category, hard asset-based businesses. These companies depend on massive investments in physical things. We're talking planes, trucks, landfills to deliver their services. This is by far the most capital-intensive model of all three. The crucial point to understand here is that growth is expensive. For an airline to grow, it can't just hire a few more people or write some more code. Nope. It needs to buy another airplane, which can cost $35 million or even more. This means that growth almost always requires outside financing, usually debt, which is a really stark contrast to a people-based business with its super low capital needs. So, in such a tough, capital-hungry industry, how do companies create a real, lasting advantage? Well, they typically win in one of two ways. They can become the absolute ruthless cost leader, like Southwest Airlines did by optimizing its entire operation from the ground up, or they can own unique and irreplaceable assets. A perfect example is waste management and its landfills. Because getting new landfill permits is nearly impossible these days, their existing assets become an incredibly powerful competitive moat that other companies just cannot get around. Okay, this table really brings it all together, showing the clear trade-offs between the models. You see, a tech-based business has incredible scalability, but it requires that huge upfront investment. A people-based business has really low capital needs, but its moat is built on softer things like its brand and relationships. And a hard asset business can build an absolutely unbeatable moat with its unique assets, but its growth is always going to be slow and expensive. As an investor, truly understanding these fundamental differences is everything. All right, we've explored the theory behind all three of these models. Now it's time to take all that knowledge and funnel it down into a simple, actionable checklist that you can use for any business services company you come across. Here they are, 6 crucial questions you should ask before you even think about investing in any business services company. This checklist is going to help you apply the framework that we've just spent all this time discussing. Here it is. First, and this is without a doubt the most important, understand the business model. Is it tech, people, or asset-based? Because that one answer determines everything else. Second, look for scale. Does the business actually get stronger and more profitable as it gets bigger? Third, seek out that beautiful recurring revenue from long-term contracts. Predictability is an investor's best friend. Fourth, focus on its ability to generate cold, hard cash. You know what they say, profits are an opinion, but cash is a fact. Fifth, size up the market. Is there still a long runway for growth, or is this market already saturated? And finally, number 6, be a realist. You have to understand the growth expectations that are already baked into the stock price, and then ask yourself, honestly, are they truly achievable? So there you have it. We've given you the map and the compass. The world of business services is just filled with these powerful, often overlooked companies. So the only question left now is, which one of these invisible giants will you start analyzing first?